Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, with the S&P 500 nearing a bear market and bond yields spiking. We'll break down where investors can seek safety amid the volatility. Plus, oil plunging as President Trump's trade war stokes demand fears. We bring you the latest in the commodity market. And we'll sit down with one venture capitalist to talk about where private capital is finding opportunity amid all of the uncertainty. All that and more coming up here on Catalysts. Half an hour into the start of your U.S. trading day, let's get a check on the markets. Taking a look at the major averages. Surprise, we've got green on your screen this morning, at least for now. Your S&P 500 up a little over 1.2% here. Your tech-heavy NASDAQ making up the majority of the gains. You can see on your screen there, the tech-heavy NASDAQ is up just about 2%. Fascinating to see that U.S. stocks are being led by tech at the moment, and that comes in spite of the fact that we had that retaliatory measure from China announcing that 84% tariff on the United States. You've got your Mag 7 up right now about 2%. Let's take a look, though, at the bond market where the craziness is continuing. You got your 10-year yield spiking above 4.35. Majority of the movement, of course, has been in the 30-year yield as well this week. You've got bond auctions. You've got a basis trade unwind. You've got foreign selling. You've got investors seeking safety. A lot is happening in the bond market. We're going to break it all down for you in our programming today. But finally, let's take a look at Bitcoin here. Bitcoin under pressure. You can see it's down nearly 3%. Interesting to see Bitcoin moving down as we do see a risk on sentiment hitting tech right now. What's going on there? We will discuss all of that and more throughout our show. And with friend of the show, host of the Trader Talk podcast, chief market strategist at Slatestone Wealth, Kenny Polcari. Kenny is going to be my guest host for the hour. He'll be with me answering my questions and asking our guest questions. Kenny, stocks, they're higher.
I have to tell you, that turnaround really amazes me because this morning after we got that China news, we saw that futures just took a dive.
Yeah.
And so I'm wondering, look, we've had a lot of damage to the market. There's been a lot of internal damage, so there's going to be a lot of churning on every headline. And so I really think that what happened was we saw that market pull back pre-market, and investors are just kind of exhausted. We've had a lot of selling, and now we're down to a level where there seems to be buyers defending the position. Now, let's just see how the day ends up. But right now, it appears as if stocks are at a level where the buyers are not necessarily being spooked by the latest China headline.
Okay, so here's the thing. For more of the retail novice investor, what do you tell them about the proneness to panic selling or dip buying?
So here's the deal. You don't want to be a panic seller. Let's just start there, right?
Never.
If you're a long-term investor, you don't want to be a panic seller. Look, markets go through these cycles, right? Over the last 95 years, we've had 50 corrections in the market, right? 15% of those have been 25% or greater. That's like every 6 years, we get kind of a 25% plus drawdown in the market. It's just part of the cycle. But that should give individual investors who are long-term the opportunity to look at their portfolios, make sure that the thesis for individual names that they own hasn't changed, and look at it as a buying opportunity. The same way, I use this all the time, the same way you're going to go into Bloomies and look at that outfit, now it's on sale, and you're going to buy 3 of them because why not? It's a great outfit. There's nothing wrong with the outfit. But you see it now down 30%, and you're going to buy 3 of them. You should think about that when you think about names like Apple and IBM and Johnson & Johnson and Coca-Cola. Those stocks aren't going anywhere.
Even Apple with the China exposure?
Well, the China thing with Apple, now we own Apple, I own Apple, I like Apple. On a discount, I'm buying Apple. I'm going to die with my Apple. I think the China thing right now with Apple, the tariff story with Apple, is going to create some stress on the stock. But Apple itself is not going away. They make $100 billion every 3 months.
Yeah.
$100 billion every 3 months. Think about that, right?
For now, yeah. For now, I think that's the big question. Kenny, super quick. Anything else that you're buying in this moment?
No, at the moment, on days like this, when we have all this volatility, I tend to step back. Like, I have a 3-day rule, right? After you have this visceral reaction, I typically wait 3 days. Then we saw the market calm down. Now we have new data today that's causing some more volatility in the markets. I want to just sit and wait this one out and just see how it plays out today.
All right, Kenny, thank you so much. Kenny's going to stick with us, and he'll be asking questions throughout the show as my guest host as well. Let's continue to monitor the market. Stocks are down over 12% from their April 2nd levels, and now even treasuries may be losing their haven appeal. So where can investors find safety? Joining us now, Rob Hayworth, U.S. Bank Wealth Management Senior Investment Strategist. Rob, great to speak with you. At the moment, it seems like investors are finding something in big tech because Mag 7 is gaining up 2% in the market right now. Is that a safe haven trade for investors amid this uncertainty?
It's great to be here, Madison. No, we'd still be a little more cautious in this environment because we think we're still in evaluation mode. We haven't seen all the tariffs come through. And I think the question for us is, where do we finally settle out so the market has a plan to push forward through, right? I think as we heard from a couple of companies this morning suspending their full year guidance, it kind of means we have a lot more questions than answers at this point about the go forward environment. And so this is probably a little more, as Kenny alluded to, bottom fishing, some attempts to figure out if we've reached that point or not. But as we've just heard in the newswire, right, EU is bringing retaliatory tariffs to the U.S. Against metals. So we'll have to see how that plays out. I think there's a lot more to head through here. That said, we think that shorter end of the Treasury curve and high quality bonds remain a reasonable safe haven here. We're seeing more volatility at the long end. Our view has been to be a little more defensive on the short end, a little more cautious in your rebalancing strategy at this point. And for those clients who think they're in the wrong objective, it's maybe a good time to start thinking about what should their long-term risk tolerance really be.
Hey, Rob, it's Kenny Polcari. Thanks for joining us. I had a quick question because we already saw it this morning in Delta Airlines when they made their announcement. Sure, they beat on EPS and they beat on revenues, but they made it very clear that they were pulling back from offering any forward guidance because they're unsure of the geopolitical concerns, they're unsure of the tariff concerns, they're unsure of the global economic concerns. If we get more and more companies that refuse to give forward guidance, should that really concern investors, or do you think that everyone should just be kind of taking this in stride, understanding what's happening?
Yeah, well, and we've seen that even play out in the uncertainty data we're seeing from consumer and business sentiment surveys, right? And now it's bleeding through into publicly traded companies where they're uncertain enough they're pulling back. We think that probably does put some pressure on the market. We think there's some downside bias to the current bottoms-up forecasts on S&P 500 earnings, which I think last night were around 268. We think there's probably downside pressure to that number as we work through the full year. And I think it's not surprising to see companies pull that guidance. That should mean investors probably need to be a little more cautious with the multiples they're applying to these companies because we just don't know how this really ends up. And it very much depends upon where do tariffs finally settle out. Right. Kind of the all-in tariff rate for the U.S. is closer to 28% at this point. Do we really settle out there, or do we settle out more in the 10 to 15% range?
So, Rob, final question. What's your single best play in this environment? If the uncertainty is not going away, what's the best thing for investors to do?
Really, so one, make sure you're in the right risk tolerance. Look to rebalance a little bit cautiously, but don't avoid bonds in your portfolio. We think there's still good income to be made there, and that's an okay place to be in the near term.
All right, Rob, thank you so much. Really appreciate it.
Thank you.
Coming up, could hedge funds be to blame for the unwind we're currently seeing in Treasury? Stocks and Translation host Jared Blickery explains next.
A wonky corner of the bond market has seemingly gone haywire the last few days, so we're digging into the basis trade today. I'm Jared Blickery, host of Stocks in Translation. Let's break this down. And as always, we're going to start with the definition, but I want to start with arbitrage because that's what this type of trade is. Arbitrage is simply buying and selling the same asset in different markets to profit from differences in prices. And the basis trade is one form of that. That's where a hedge fund is on a levered basis is buying a government treasury bond, that's in the cash market so-called, while selling a similar futures contract aiming to profit when the prices move closer together. So they're buying the cash market, they're selling the futures, and they're hoping that these prices converge. So let's just outline exactly how this works. So you're a leverage hedge fund here. You are buying treasury bonds. And again, when I say the cash market, we have a very liquid cash market for treasury bills all the way up to treasury bonds. And then we have futures that are based based on that. And the futures prices typically don't move as much as the cash market. So what they do is they buy one, sell the others, and they wait for these prices to converge. And in theory, that leads to profit. But sometimes things go wrong. Sometimes the prices move the opposite direction. So recently we had Treasury yields dropping sharply last week, and this meant that the prices, instead of converging, they were diverging. And so all these hedge funds had to unwind their position. This forced them to sell Treasuries, and remember that the price of Treasuries moves inversely to yields. So they were selling all these Treasuries. Suddenly the yields are skyrocketing when they had been falling before. All of this causes liquidity to dry up. And when the liquidity in the bond market dries up, there's not a lot of cash left over for risk markets. And that's very important here because we often talk about the dangers of bond market volatility, why it affects risk markets so much. And that's because there's just not as much juice left over. I think it's instructive that gold was selling off in all of this. And that was because gold is a very high quality item, but even it had to get sold to fund some of these losses here. So I just want to close by showing you the size of this trade. This chart goes all the way back to before the global financial crisis, which I'm highlighting right here. That was that shaded area, but you can see it wasn't much of a thing back then. We had pretty low interest rates compared to the present, and especially with respect to Treasury market volatility. It kind of became a thing in the run-up to 2018. In the pandemic, it really fell off a bit as we saw yields plunge, but it's become bigger than ever, at least bigger in decades. The highest point on this chart in very recent history, it is an $800 billion trade, and I think given the structure of the market, it's probably here to stay for a while, and there are definitely echoes of the 1980s. So tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, thank you so much. It's now time for some of today's trending tickers. Scan the QR code to track the best and worst performing stocks of the day with Yahoo Finance's trending tickers page. Today we're following Apple, Alibaba, and the drug makers. Let's take a look at Apple, up 3% right now as President Trump's 104% tariff on Chinese imports takes effect. Still, the stock's recent drop put Microsoft back on top as the most valuable company in the U.S. this week. Kenny, your company Slatestone has Apple as a top holding. Talk to me about whether or not anything has changed in your view for Apple.
So at the moment, we have not changed our view. The fundamentals for Apple, the original reason we own it, have not really changed. Yeah, is the tariff, did that throw a curveball? It has, but we're not in a position to say, okay, we're eliminating Apple from the portfolio. It's not. Just like like we talked about before, I'll die with my Apple, because it is what it is. But no, Apple, in our view, and it's up today, so that's great. It makes me feel good because I own it as well. But I think part of that is because it's off significantly, right? It's a lot of these big names that have been off, that have been sold, and they're off significantly where investors are finding opportunities. So.
And they're also apparently finding opportunity in China today. We've seen China stocks ripping here. I do want to talk about Alibaba reversing its earlier gains. The Chinese tech company was seeing gains despite U.S. tariffs on China taking effect, and President Trump hitting China with that 104% trade levy, China hitting us back with that 84% tariff on all U.S. goods. It
was interesting. If you looked at Asian markets, every one of them were down overnight except Hong Kong and China. They were both up. China was up 1%. I think Hong Kong was up 0.75%. But Taiwan was down 5%. Japan was down 3%. So, yeah, I think people are looking past and China stocks today and Alibaba. We could talk about that, I guess, right?
Well, we can talk about Bob, but one of the things I'm interested in is where investment theses go as we're kind of taking a step back from globalization. Yeah. We had China issuing a travel warning for citizens going to the U.S. Right. Are U.S. investors going to be interested in China stocks if this trade war gets to a point?
So I'm very biased because I don't own China stocks, right? And the reason I don't is because they don't play by the rules. The rules can change at any moment, right? You own a Chinese stock and then suddenly you wake up and they change the rules and your investment goes to pot. Mm-hmm. So I tend to have my China exposure through things like Apple. Right. I don't invest directly into China just because I think there are other places. There's Europe. There's certainly in the U.S. There are other opportunities for kind of long-term investment where I feel stable and safer. because we're not going to change the rules the way China changes the rules.
Well, and talking about changing the rules, Treasury Secretary Scott Bessent on Fox Business this morning saying that the U.S. could potentially delist Chinese stocks as well.
Well, there's been that conversation has been ongoing back and forth because they don't play by the same accounting rules, and so there's been a lot of push and pull back and forth about what should we do with China stocks because they don't play by the U.S. rules in terms of listings.
Right.
So that's going to be interesting to see if it finally catches on this time.
Yeah, certainly a transparency question, but do want to talk to you about the drug makers falling today on President Trump's tariff threats. The president commenting at the National Republican Congressional Committee dinner saying he's going to announce a major tariff on pharmaceuticals very shortly. You can see on your screen Pfizer, Merck, Eli Lilly, all moving to the downside. Kenny, are these ownable names in this environment?
Well, so here you go. First of all, I think they are because they're big, massive drug companies, and so in the long term, yes, I think they are. Now, are they going to come under pressure with this? Certainly, investors are selling it, or some investors are selling it right now, based on this news. But look, we need the fact that a lot of our drugs are produced overseas, and we're dependent on those markets to produce our drugs, I think is a national concern, right? So I think there has to be a push for the U.S. to produce our own drugs in-house, quite honestly. So while I think this is not necessarily a positive for the drug stocks, I think long-term, those names, Lilly, Merck, all the names that you just mentioned, are fine long-term holdings.
Is healthcare still a safe haven trade?
Well, I think healthcare is a safe haven trade. Look, there's a lot of us baby boomers that are getting ready, right? So I think healthcare is a safe haven trade. Again, when the broad market's coming under pressure, they'll all come under pressure, but healthcare will come under less pressure.
Yeah.
So yes, I'm bullish on healthcare certainly for the long term.
All right, Kenny, great to have your insights, and you'll be with us for our guest interviews throughout the show as well. We'll have all your markets action ahead, so stick around. Escalating tensions between China and the U.S. are taking a toll on exposed U.S. companies. Shares of Apple have fallen over 20% in the past month due to its heavy reliance on China for manufacturing, with no clear signal that a negotiation between the major economies is near. So where does that leave companies caught in the middle? Joining us now, Nazak Nakakhtar. She is a partner at Wiley Law and a former trade official under the first Trump administration. Nazak, great to speak with you. Talk to me about how you would advise a company like Apple in this moment. What would you be telling them about whether to bring manufacturing back to the U.S. to spend the money to do what the administration wants versus waiting it out or moving to a country that has a lower tariff?
Well, great to be with you. And that's exactly the way to be thinking about it. I mean, for companies, it's, just the idea of moving a supply chain is, a multi-million, $100 million, billion-dollar value proposition. And you can't really do that every few years. So for companies like Apple, they're going to have to think about, where is it going to be sustainable in the long term? What is the climate like in that country? Is it a democracy? What are the prospects of long-term economic stability there? And then trade relationships with the United States and the rest of the world. Everything's volatile right now, but looking at the countries and looking about really the geopolitical stability is going to be key. We want things to move back into the United States, but let's be realistic. Not everything can move back into the United States. We got energy constraints. We've got workforce constraints. So companies are going to really have to look at do the economics make sense in the short, medium, and long term.
Nazak, it's Kenny Polcari. Listen, and I agree with you 100%. You can't necessarily all of a sudden say Apple's going to start producing in the U.S. It's just an impossibility to do it overnight. But there are plenty of other places, and they've already started to kind of fan out. Vietnam, India, those are places that might, in fact, actually look at the current situation between China and the U.S. and China and the rest of the world and look at it as an opportunity to jump in here and steal some of that, which I think they're already doing, which I also think that it would be perfect for Apple to kind of shift more of that production to those countries, because I think they're going to get a better deal, quite honestly, if they come to the States and negotiate a better deal, which China doesn't seem to want to do at the moment.
I mean, I think really just going back to the earlier point, looking at each country makes a huge difference. Look, Vietnam is a non-market economy, right? It's still a communist country. There are going to be issues with that country, and the U.S. government is going to have issues. Even though Vietnam has said that it's going to reduce its tariffs down to zero, that's honestly not going to make a mistake because the disadvantages to U.S. manufacturing stem from other aspects of Vietnam. India is in a completely different story, right? It's a democratic country. The president really likes Modi, and the Indian government has done a lot to really signal that they want to improve trade relations with the United States and reduce their barriers. If we can deal with India, being part of the China's BRICS and get them to ease off China, I think India is a really good prospect for American companies to manufacture there.
Talk to me about how you see other countries either banding together or coming apart in this moment. The EU this morning adopting tariffs on 21 billion pounds of U.S. goods in a metals dispute. Do you anticipate the EU, even China, other nations coming together in this moment to fight the U.S.? Or do you think that the Trump administration is going to be able to put pressure on other nations to ostracize China even further?
I genuinely don't think that the countries are just going to flock to China because they just see the problems with China. And they've been seeing, at least for the last decade, right, the problem with increasing trade relationships with China. So I don't think that that's going to happen. I think right now we're going to be in a position where countries are just going to fend for themselves. They're going to try to sort of improve trade relationships with one another, like Canada and Europe. But at the end of the day, we all need each other's markets. And, there's going to be a period where the tit for tat measures are going to continue. But I think at the end of the day, every single country, I think including the United States, is going to want to better integrate their supply chains and really, frankly, reduce their barriers to trade, because this situation, this status quo cannot continue. And I think we're going to get to a better place. And I think we're going to get to a better place, within this year, probably in the fall. But right now, I think every country is going to flex its muscles to show their constituents at home that they're going to fight back until the pain gets too much. And then I think they're going to work with the United States and collectively on a path forward.
Yeah, I think if it is true what we're hearing, and all these countries are coming, calling up the White House saying, I want to make a deal, I want to come and negotiate. If that's true, then I think it is, then I think the second half of the year will prove to be better. And so investors, individual investors, really need to kind of take a step back and not overreact and not get themselves into a panic over, what I think is going to be, like you, I think is going to be more of a short-term issue.
I think, look, the panic is a little bit sort of short-term, misplaced. It stems from people not understanding Washington,
right,
too, and not understanding that these tensions continue until they subside and countries decide to work together. But in the global trade, inherent in global trade is friction. Inherent in global trade is geopolitical disputes. And those disputes generally among like-minded democratic countries that share the same value system and commitment to a rules-based system, those negotiations will happen. We'll ultimately get on the same page. This is just a short-term disruption to get to a better outcome, and I'm certain we'll get there.
100%.
All right, Nazak, thank you so much. Really appreciate it.
Great to be with you.
Let's get a check on the major averages here, still moving to the upside. You've got your S&P 500 up about 0.5%, but your tech-heavy NASDAQ still responsible for the majority of the gains here. You've got your tech-heavy NASDAQ up just about 1.3% here. And taking a look at what exactly is moving underneath the surface here, tech and consumer discretionary, the two biggest gainers in the S&P 500. I want to point out that those have been the two biggest laggards as of late, and information technology up over 2% in your S&P right now. I do want to get to the oil market. Crude oil prices sinking to a 4-year low as the trade war escalates. China raising tariffs on U.S. goods to 84%, while higher levies on about 60 U.S. trading partners go into effect. Weakening demand expectations fueled by President Trump's aggressive tariff policies, coupled with OPEC's decision to accelerate crude production, are what our next guest calls the 1-2 punch combo that's knocking out oil markets. Joining us on that call, Rebecca Babin, CIBC's senior energy trader. Rebecca, talk to me about this move in oil now below $60 a barrel. Just your thoughts.
So we've moved about 20% lower in 7 days, and I'm kind of calling this the Mike Tyson moment for crude, where everyone has a plan until you get punched in the face. And crude has kind of gotten punched in the face here. The demand profile clearly weakening with the risk around tariffs. We're seeing analysts who were expecting 1 million barrels a day of demand growth ratcheting down their estimates to about 500,000 barrels a day of demand growth if the trajectory of tariffs continues along this path. And potentially worse, we could see all demand growth wiped out if this continues to escalate, right? So that was kind of the first punch, and obviously very detrimental to how crude's going to trade. The kind of knockout punch came from OPEC last week when they said, you know what? We're not going to actually be that supportive mechanism in the market like we've been on previous sell-offs. We're actually going to increase our production faster than the market was anticipating. And that really kind of has shaken a little bit of that, where's the floor in crude? When people think about, okay, where if demand's coming off, we need supply to rebalance here in order for crude to stabilize. And we don't see production coming off from a producer like Saudi Arabia. We see it increasing. That kind of leaves us in this place where we need a supply response. It will come from U.S. shale. That is the swing barrel. We're starting to get to prices where we'll see shale producers particularly start to reduce CapEx and lower supply, but we're still feeling that out right now. And losing that OPEC kind of security blanket for the market has been part of the reason why these moves have been so extreme.
So, Rebecca, it's Kenny Polcari. Thanks for coming. I got to tell you, and I'm not sure, but I'm kind of on the opposite side of this argument. I don't think it's a demand issue at all. I don't think demand is going to wane at all. I think there's massive demands on energy. I think it's clearly an oversupply issue. And to your point, Saudis came out and now they ramped it up even more than what we expected. And they're going to flood the market. They're going to try to bring oil prices down because, look, they can operate with oil prices at $40 or $45 a barrel. It's the U.S. shales that are going to get kind of punched in the face if that happens, and then supply will get withdrawn from the markets and it will stabilize. But I don't necessarily think this decline in oil is because there's a waning demand issue. I think demand is strong and will be strong. I think it's absolutely an oversupply issue.
Kenny, I think that's a valid point because the data up until now has shown that demand has been okay.
Right.
But I think what the market is telling us when they look forward on these tariffs, particularly that are aimed at where most of demand growth is expected to come from, that's India, China, Vietnam, Southeast Asia, developing nations, and the tariffs are hitting hardest there. It's this idea that we have to lower that demand estimate. I don't argue the point that demand is okay right now. I think what the market is thinking and trying to forecast is where is demand in the future and do I need to take it down? The oversupply comment, I agree with. One thing I would kind of push back on there is I don't know if OPEC is going with the flood the market strategy. If they wanted to flood the market, they could have brought back 1 million barrels, not decided to go from 110,000 barrel a day increase in May to 400,000 barrel a day increase. I'm not sure that's their objective. Their objective may be more along the lines of let's show Donald Trump that we're willing to play ball here and see what we can get as part of these negotiations. I don't think that they want to see crude in the 40s. Yes, they can still be profitable, but keep in mind, they have a huge budget expansion going on, and they actually need crude in the high 80s to even get close to balancing that. I don't argue the premise of some of that. I just think there's nuance here we need to take into consideration.
And I agree, because if they really wanted to kill it, they would flood the market. To your point, absolutely, because they can. So I do think, though, that they came in, they announced a bigger production increase than what the market had expected, for sure. I think to your point, I think they're trying to test the market a little bit and see where that leaves them and be able to be part of this ongoing conversation. Absolutely. But I don't think, just to say it, I don't think demand around the world is waning at all. I'm in that camp.
Well, let's see what happens. Delta Airlines came out today and said they're pulling their guidance and travel's down. And there are some leading indicators that there might be a demand hit. But I'm with you. The crude market in general, I think in these environments, really does tend to pull the rug out from where they think demand will be, and that can overshoot what the impact will be. And then we see the numbers and demand actually turns out to be better than those worst case scenarios. So I would absolutely say there is a chance that the market is pricing in a bigger demand hit than will come to fruition. And I think you do have history behind that. So I agree with you on to a certain extent on that one, Kenny.
Yeah. Rebecca, thank you so much for making the time. Always appreciate your insights on the oil market. And also thanks to our guest host, Kenny Polcari, for his opinions on the oil market here as well. Coming up, we're going to talk the state of venture capital amid the market volatility with Ben Lehrer. He is the managing partner at Lehrer Hippau. Next on Catalysts. Seed stage venture capital firm Lehrer Hippau announcing it's raised $200 million for its ninth fund, looking to deploy its cash pile at a volatile time for financial markets. The firm has previously invested in companies including Warby Parker, Oscar Health, and Casper. Joining us to discuss the new fund and where they're looking to invest, Ben Lehrer. He is the managing partner at Lehrer Hippau. Ben, thank you so much for being here. So you've got all this cash to deploy. Tough moment to find places to deploy it. What are you thinking right now?
Well, if you look at sort of what our strategy is, we are true early stage investors. We only invest in pre-seed and seed companies. And so we're investing on a very long-term horizon. These are companies that will mature over the next decade plus. And so while this is obviously a pretty trying moment from a macro perspective, it doesn't have all that much effect on sort of our day-to-day in terms of new deployments. We're looking for great, very early companies and founders that we think are going to transform industries, and these tariffs lots will happen between now and the time that these companies mature.
Yeah, lots certainly will, Ben. I am curious though, because obviously, as we mentioned in the intro, you've got a lot of logos to your name that are direct to consumer brands, Warby Parker, Casper, for example.
Yeah.
What happens to those companies if in their infancy these tariffs were in place? Like how do these headwinds in the market and the volatility impact kind of the birth rate of these bigger brands?
It's a really, really good question. The reality is we do less of that sort of physical product investing these days and have sort of largely transitioned into just like more pure software over the last several years. I think that there's macro factors very separate from tariffs that have sort of led to some of those shifts. But that doesn't mean we do none of them. And I do think that these are real considerations. I've been checking in, and we've been checking in with our portfolio companies that are affected by tariffs, and it's a scary moment, and it feels very sudden, and people don't know the sort of shape of the ground that they're standing on, and people are being careful not to overreact right now because this is a very fluid situation. But the reality is that this is going to put pressure on some businesses, and not unlike COVID. People are going to need to adapt, and it's going to be hard for some companies.
And what are you hearing from the CEOs of your portfolio companies, just in terms of anything they're doing to navigate around these tariffs or any pushback that they're doing to the administration?
So, if you go back to the last sort of crisis for the, venture market back in sort of 22 and into early 23, coming off the highs of the 21 market, I think that a bunch of companies were caught flat-footed. They had been in sort of this go, 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 grow mindset. Money had been cheap, and suddenly things turned, and there was some irresponsible sort of behaviors happening, I think, across the industry. Right now, I think that we're in a more responsible time period. Of course, there's some bubbles in areas of sort of AI infrastructure where there are some pretty, run and gun things happening. But for the most part, we feel like this is coming at a time where companies have been acting more responsibly. Burn has been coming down. There's been more of a push to get profitable earlier. And so I don't think people feel like they need to wildly overcorrect.
Sure.
And that's a really good thing. I had a conversation with our partnership yesterday saying we feel very different about the status of our portfolio today with this new sudden crisis than we did 3 years ago when the market turned.
All right, well, that's really good context. Ben, I can't believe we've gotten this far into the conversation and I haven't mentioned AI to you. That shows where this market is currently at 6 months ago. It's all I'd be asking you. So talk to me about how you're viewing AI investments. How much of your investment is going to be in AI specifically moving forward?
6 days ago, that's all you would have asked
yes.
me. And maybe 6 days from now, that's all you'll ask me again, depending on how all this goes. But look, AI is at the center of everything that we're investing in, and frankly, that everybody is investing in. Not unlike, sort of the shift to mobile or cloud. This is just a massive moment of sort of reinvention. It creates enormous opportunity in any category you can think of, and also risk. And so, sometimes we're investing in companies that are real AI companies and that are being built to sort of enable the use of AI across the industry. In other cases, we're investing in companies that are just thinking about how they're going to use AI internally to run their businesses very differently and more efficiently, how they're going to create new products for their customers, bringing AI to the forefront. And so it's a part of every conversation, and it should be. But it is still, I think we're moving into a world where this is table stakes, and where sort of the hype around it goes away because it becomes something that is taken for granted that it needs to be core to every new company.
When you're looking at different pitches right now, different founders, who's standing out to you? Like, what's the kind of rubric for success right now?
It's every company is a snowflake, and everything is different. I think generally speaking, we again, as early stage investors, we really are very focused on teams and sort of teams that have right to win and differentiated insights in the spaces that they're building in. We're looking for that founder market fit. And one of the things that we tend to sort of gravitate towards is what we sort of joke around and call fully formed humans, which are people who have had some experiences in their career. Oftentimes it's second or third time founders who sort of have scars from seeing things work and seeing things not work, and we think of as being responsible stewards of capital who have proven successes in the past, and we take comfort in working with those kinds of folks who we think really know how to take responsibility for building and winning. And so that tends to be one of the qualities we really focus on.
And are you shifting any of your investment into companies outside of the U.S. right now?
No, we've always been sort of U.S. market focused. We do invest in companies that are based, we have companies in Israel and in areas of Europe, but always companies that are sort of intending to move into the U.S. and focus on U.S. customers. And so we'll continue to do that. We are seeing an interesting thing that's been happening culturally, where you have European and Israeli founders who, as they target the U.S. market, really see New York as the place that they want to go. And so, the proximity to where they are, and smaller time changes than going to the West Coast. Obviously, sort of the cultural richness of New York, and the fact that their customers are here almost independent of whatever they're doing. And so we are seeing an interesting influx of folks targeting sort of building in New York or building cross-border with New York as their U.S. hub, and we're going to continue to take advantage of that.
All right, Ben, thank you so much. Really appreciate it.
Thank you for having me. Really appreciate it as well.
Let's get a check-in on shares of Amazon, still moving up about 1.5%. The company reportedly canceling some orders from China as 104% tariffs go into effect on the nation by the Trump administration. Now, this also comes as Bank of America this morning cutting their price target on Amazon to $225 from $257. But within this note from Bank of America, interestingly, they do say that Amazon is relatively well positioned in retail given the low cost focus. This is something that we also heard from Walmart's CEO talking about how they can use this opportunity to take up market share because they will deploy cash that they have on hand to keep costs low for consumers. That's good news, of course, for investors. Obviously, you can see Amazon along with the rest of the tech stocks moving to the upside today, but it's also potentially good news for consumers who are concerned about inflation and about prices going up. If these companies can deploy capital to be able to keep prices low, that is something that it seems like consumers would welcome amid this environment. Again, Amazon canceling some of those inventory orders from China upon introduction of additional tariffs. We'll be back with more next. ETFs had their most active trading day ever this week, with $633 billion worth of trading just on April 7th. That represents over 40% of all equity trading volume, as investors clearly searching for certainty and moving around money amid a seesawing market. I want to bring in Julie Gunz, AllianceBernstein Global Head of ETF Strategy and Partnerships, for this week's ETF report brought to you by Invesco QQQ. Julie, thank you for being here. Appreciate it. So,
thanks for having me.
Obviously, a lot of activity going on. What are the flows indicating to you about sentiment at this moment?
Sure. I mean, it's really interesting. Like you said, ETFs had a record day on Monday, represented over 40% of the ETF flows, and the flows are changing day to day. So if you look at the weekly flows for last week, big inflows into fixed income, outflows into equities. I checked the flows this morning, that's reversed. You're seeing equity inflows into kind of just mainstream US stocks. I think people buying the dip or potentially taking advantage of market dislocations to do some tax loss harvesting. We still see some inflows into safer fixed income, so short duration, ultra short, almost an alternative to cash. But we saw selling yesterday in kind of the riskier parts of the market, in credit, high yield, CLOs, loans, as people try to figure out, what does the future look like and how to position for the volatility.
So I'm curious about, because ETFs clearly are a way for people to get broad exposure. I get it. But now that the market's had this big drawdown, you have leverage ETFs, right?
Yep.
Triple leverage ETFs, which can cut both ways depending on which side you're on, right?
Yeah.
But I'm curious if you've seen with this big drawdown, if you've seen more money, people making a bet like they're going to go long the S&P, that it's down here, so they're going to go long the triple leverage ETF.
Yeah, so I haven't seen that. I think, exactly, people have gotten a bit burned by those over the past few days, so I don't know if they're willing to step back in yet.
Right.
But we did see broad-based buying yesterday in kind of the more traditional S&P kind of NASDAQ ETFs.
I think what's important, though, for the listener to understand is those triple levered ETFs are not long-term plays at all. They're very strategic.
Yep.
If you want to go in ETFs, to your point, the broad ETFs, whether they're sector specific like tech or healthcare or consumer, or broad the S&P. But when you talk about specific leverage ETFs, investors and traders and the retail public has to be very careful with them because they can cut so quickly.
Yeah, and I think that's a very key point. Like, there's an ETF for almost everything today. So understanding, do you want passive beta exposure? Are you looking for certain subsets of the market? Active ETFs have seen huge growth. So at AllianceBernstein, we're only active ETFs, and so that even opens up another subset of the market where if you want, a research-driven process, if you're a bit more of a long-term investor, there's an ETF for you as well.
Right.
And I've been getting, and I'm sure we've all experienced this, but I've been getting like hundreds of questions a day and on social media from folks asking, okay, I hear the stock market's on sale. Should I be getting in? Like, what should I do? Should I finally open a brokerage? Are you able to suss out how much new money is part of these ETF flows?
I wish I could. The beauty of ETFs is that they're exchange traded.
Right.
One of the downsides of ETFs is you don't know who is buying, selling at the time. I think, the trends that we're seeing, ETFs in the US saw over $1 trillion in net inflows last year. Year to date, it's $300 billion. Like, there is demand. And so I think, the shifts we've seen within the last week are probably people repositioning within ETFs, but also net new money coming into the vehicle.
But it's easy to do that in an ETF because it's liquid, it trades like a stock, unlike a mutual fund, which is not so easy to trade, right? You get the end of the day price and that's it. In an ETF, I think people feel like they have more control. And you can also recreate almost any mutual fund with a range of ETFs.
Mm-hmm. Yeah, and exactly. Like, I think the beauty of the ETFs, there's a few things. There's the transparency, so you know what you own on a day-to-day basis, whereas mutual fund, there's usually a lag in disclosure. There's the intraday trading. So when you want to get into something, you get the price, at executed, not the end-of-day NAV, which it might be for the mutual fund. With the proliferation of active ETFs, you can, like I said, buy almost anything in an ETF, and so you're given a lot of choices.
Go ahead.
And it gives you also for the listener, if they don't know that, you can drill down into the ETF to see what the actual percentage weightings are. So for instance, in the XLK, you can see the top 3 holdings make up nearly 40% of that ETF. And you, without necessarily realizing it, if you own Apple as an individual investment and now you go buy the XLK, you could potentially be becoming overweight in Apple just because of the position it has in ETF. So people need to understand that as well.
Yeah, and I think that transparency into holdings helps the end investor who wants to open a brokerage account, but it also helps financial advisors and look at their portfolio of risks, because the different tools can dig into the underlying. And exactly as you say, I own these 5 ETFs. They're all overweight Apple. I'm actually very exposed to Apple.
Right, and that's an issue that investors need to make sure they understand.
Yep.
Yeah, absolutely. All right, Julie, we got to leave it there for time.
All right,
Thank you
great.
so much for
Thank you so much
joining
for
us.
having me.
And thank you to Kenny Polcari for being my guest host for the hour.
Thank you
always
for
appreciate
having
your
me.
insights. Always appreciate your questions to our guests. Really appreciate it, Kenny. I do want to do a final check on the markets here. Let's take a look at the major averages. Okay, so your S&P 500, it flipped into the green. It was up as much as 1.5% when I started anchoring this show 55 minutes ago. Now it's down about 0.3%. Your tech-heavy NASDAQ up just about 0.4%. Interesting here is that we did start to see tech and consumer discretionary names being the biggest gainers in the S&P 500 over the last 20 or so minutes. Those are still holding. You've got healthcare being one of the biggest losers of the S&P 500 right now, and also utilities. So interesting to see whether or not there's a question mark about healthcare as a haven status trade amid that tease from the president about increased tariffs on some of those pharmaceutical names. You got those stocks under pressure this morning. Let's take a look, though, at the bond market. You've got Treasury yields continuing their move to the upside, particularly at the longer end of the curve. We've got Treasury auctions this week and questions about foreign demand for Treasuries. So I know it's a little bit wonky, but we want to watch those Treasury auctions to make sure that foreign demand for Treasuries is holding up amid so much uncertainty. Coming up, we got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith. He'll have you for the next hour, so stick around for more.